second day of the Fung Global Institute, the Carol sessions. Let me first introduce myself. I'm Teh Kok Peng. I'm the moderator for this session. And I hope that the speakers, I think we're on a tight time schedule, so there's a timekeeper over there who will give signals when we exceed a certain time period. I think in a highly influential book that came out a few years ago, just after the global financial crisis, called This Time is Different, by Kenneth Rogoff and Carmen Reinhardt. This book documented all the financial crises that has taken place in the world for the last 600 years. You would have thought that mankind would have learned something after the financial crisis, after all this time. Yet, we just had the mother of all financial crises since the Great Depression, and we are still in the midst of it. And which really run the risk of a serious relapse, depending on the outcome of what is going on in the Eurozone. I think in Asia, we did learn some lessons from the Asian financial crisis. And as you know, more than 10 years ago, then the biggest financial crisis ever since the Second World War took place. And in Asia, I think what happened, if you look back, the countries in this part of the world took the pain, either willingly or forced to by the IMF. And since then, I think the countries in this part of the world has put its house in order. They've reduced the budget deficit, they've run a current account surplus, they have made sure that both households and firms do not get over-leveraged. So I'm honored today to be moderating this session with a panel of highly distinguished former and present central bankers and regulators. And they will talk about how we can learn from the Asian and global financial crises. And they will give us their country, regional, and global perspective. In accordance with the brief of this session, they will help us rethink the Asian financial systems to help us avoid systemic risks, serve the real economy better, and to further sustainable and equitable growth. I will introduce the speakers in the order in which they will speak. First to speak will be Sir Howard Davies, who teaches at the Sciences Po University in Paris. Sir Howard, previously before this, was the director of the London School of Economics, and before that he was a deputy governor of Central Bank in the Bank of England, and then the Financial Services Authority in the UK from 1997 to 2003. Next to speak will be Mr. Mingkang, who is now a distinguished fellow at the Fung Global Institute, and before that, he was the chairman of the China Regulatory Commission. I think most of you would have heard him speak yesterday. He was the keynote speaker, and he gave us a very inspirational speech, which ranged from the current financial problem, what he has done in China in reforming the banking crisis. Perhaps he will play an active role in the years to come in this whole issue of global climate change, which is probably, in some ways, in a long state of history, far more important than the financial crisis we are living through. After him, Mr. Reddy, the former governor of the Bank of England, will give his perspective, working from the global, then regional, and then to India-specific issues. Mr. Saito, the president of the Tokyo Exchange, will provide his views on what Asia is doing and can do more to increase financial intermediation among Asian countries, as well as to reduce the cost and improve the efficiency of such intermediation. Finally, Mr. Chi Pin, who just landed this morning. I think he was held back from coming earlier. I guess some visa issues and so on. So we are very glad that he is able to make it in time. And he's going to talk about the lessons that the CSRC has learned from the financial crisis and what CSRC is doing right now in China in terms of improving and reforming things. So without further ado, can I call upon Sir Howard to kick off? Thank you, Howard.
Thank you very much, Teh Kok Peng, and thank you for finding on. It's a pleasure to be part of this conference, and particularly to be on this panel alongside MK, YB, and others whom I've known for some time. Now, Kok Peng asked me to begin with what's going on in Europe, and partly because that, of course, is a preoccupation on the front page of every newspaper at the moment. But to do so, I hope in a way that tries to link across from what's going on in Europe into Asia, because that's really what we are talking about here today. I recall that a couple of years ago, I made a speech in Delhi, which was called Europe, the Lost Continent. And at the time, I was responding to a widespread view in Asia, but also to some extent in the US, that somehow Europe had dropped off the map economically and financially, and was no longer of great interest to the rest of the world. Well, the European Union has succeeded in making itself interesting again, and perhaps the cost of doing so may be quite high, but nonetheless, we're back on the front pages, and that's some kind of result for us Europeans. This has had all sorts of interesting consequences. There was a rather interesting report just on Monday of this week in London about imports into the English language from America, and detailing all the number of things that we now have to say, ridiculous phrases like going forwards, meaning in the future. This is the American myth that any move forward in time is by definition progress, which strikes me as being completely misunderstood, and how you have to use the word like as more or less every other word in every sentence. But the Eurozone crisis has also generated a vocabulary of its own. We now know about Brexit. Now that we know about bank jogs, a phrase we hadn't come across before, this is preparatory to a bank run, I think. And now that the focus has moved from Athens to Spain, we now know about Spandemonium. We've heard about Spanic, which may lead to Spain leaving, which is known as Squits. That's the only toilet reference there will be this morning. It's also produced quite a lot of wry stories. The only one perhaps repeatable here and short enough is that the man arrives at Athens airport and the immigration officer takes his passport without looking at it, looks at it and says nationality, he says German. The man says occupation, he says no, just visiting. But as we watch the evolution of this crisis, it is a little bit like watching a slow-moving train crash. And this is not, I think, the place for a detailed taxonomy or even perhaps an autopsy of the Eurozone. But what I thought I would do would be two things as quickly as I can. One, to give you a purely personal forecast of how I think this will play out in the coming months. I'll do that very quickly. And then some potential lessons for Asian finance, which will be a segue into the real topic for the day. First of all, the end game. Well, at the moment, all solutions to the Eurozone crisis can be put in one of two boxes. Box one is solutions which are politically possible, but economically and financially hopeless. Box two is solutions which are economically and financially sensible, but are politically impossible. Currently, box three, which are things which are politically possible and which would be economically and financially useful, is currently empty. We need to fill this box, and I think that it will eventually be filled, but things will probably have to get somewhat worse before we do so. I fear the outcome will be that Greece will in fact exit. I think the Greeks will not be able, no matter what happens in the election on the 7th of June, to deliver on the austerity package that they have in front of them, and that when they don't deliver and come back to the EU and to the Troika, there will be very little appetite for providing them with a new package. And then they will be obliged to default, And in principle, they could default and stay in the Eurozone. I think everything is possible, but I think for them to kickstart their economy, I fear that they will probably have to leave. I think that that will be the Lehman Brothers moment for the Eurozone. And just as in September 2008, the Fed then had to embrace the other investment banks, a loveless embrace, you might think, that the EU will need to protect the rest of the zone. Because I think what cannot happen is that Greece goes and the EU says, well, that's interesting, now let's see what happens next. Because I think that would create a contagion and a run which would be completely unmanageable. So what would happen then? Well, I think some combination of mutually guaranteed euro bonds, of the ECB buying debt from Spain and Italy on issue, a lender of last resort for banks, in other words, a bigger firewall created by a European stability mechanism, and a pan-European banking supervisor and mutually guaranteed deposit insurance. I think that sort of package will have to be produced. That will involve a significant deepening of the Eurozone. I expect that rather than a breakup, because I think the political investment in the Eurozone is simply too high. And politicians, unlike business people, do not have a notion of sunk costs. There are too many sunk political costs in the Eurozone for it to be abandoned. One side effect of this, which has some interest for me as an Englishman, though perhaps not for many other people in this room, is that those who are currently out of the Eurozone by choice will be even more distant from it in the future than they were in the past, and we will be moving explicitly to a two-speed European Union. I think there's a reasonable chance the UK will end up completely outside the European Union, but that will depend on some evolution of domestic politics. Now, some will contest this forecast, but I just put it on the table because I think it's useful to have an idea about what might happen and how things might evolve, and that's my current view. Now, the lessons and consequences, particularly focusing on Asia, well, the economic consequences are, of course, pretty serious, and I think will be quite material in the next few months. The EU took over as China's main trading partner from the US in 2007, and therefore a slowdown in the Eurozone, which strikes me as being inevitable, is going to have an impact. But here we're more talking about finance, and I think financial matters will be also noticeable, because EU banks provide, according to the Asian Development Bank, 9% of total domestic credit in this region, 3 times the share provided by US banks. And EU banks will be pulling back from this, indeed are doing so already, because they are needing to protect their capital position domestically. They're being forced to increase their capitalization, and that is involving them in pulling back from businesses, reducing lending, indeed selling off businesses where they can do so. And so I think that the Fung Institute is right to focus particularly on trade finance, because a lot of this is in the trade finance area, and looking at the way in which Asian banks can step into that emerging gap. And this may, of course, involve some regulatory changes in Asia as well to facilitate that process. Now, turning to the regulatory lessons, some, of course, of the lessons in Europe are very specific to the problems of a currency union. So let me just pick out 4 of the ones that I think are broader and not specifically just related to the EU. One, it seems to me that pre-crisis we had reached, in the West anyway, a kind of end of history in relation to monetary and financial management. That had 3 elements. One, that you typically gave different tasks to different institutions, monetary policy and regulation often being separated. You had an inflation target, and you did one big repo a month to fix the short-term rate. Capital requirements were set globally and fixed for all time. And that was it. Basically, we thought that was a kind of end of history in terms of how you managed complicated financial markets. I think we have now learned painfully that there are many complex interactions between monetary policy and financial policy can be divided into macro and micro, and the linkages are complicated between the two as well. And also that we need more regulation through the cycle. We had an element of pro-cyclicality in the regulatory environment pre-crisis. As a matter of fact, we may have some pro-cyclicality post-crisis as we are tightening capital requirements at a time when lending and credit are weak. But it's arguable that we really need a different kind of framework for thinking about how these things interact. And I believe that that general point is as relevant in Asia as it is in Europe. In Europe now we're moving towards different structures, the European Systemic Risk Board at the EU level, the Financial Policy Committee in London, which are attempting to integrate these things and provide intellectual frameworks for thinking about these interactions. And I think that they do have some lessons in this region as well. Second point is a linked one, in that I think we now better understand the relationships between the health of banks, the health of the sovereign, and the robustness of deposit protection schemes. Deposit protection schemes have tended to fall somewhat out of focus in the West, because in the UK, for example, we hadn't had a bank run for 150 years. When bank runs happen, people become quite interested in deposit protection schemes again, and bank runs can catch on. As Mervyn King perhaps unhelpfully pointed out, it's not rational to start a bank run, but it's rational to join one once it's underway. And therefore the arguments for more visible, pre-funded deposit protection schemes, I think, are much more powerful now than they were pre-crisis. Thirdly, I think we now see the need for a more diverse set of tools to manage the financial system. Now, arguably, this is a lesson that we should have learned from Asia. Indeed, we had moved towards a feeling that you were rather hands-off from the financial sector. You set a fixed set of capital requirements, and banks organised themselves within that framework. As John Gapper said actually just in yesterday's Financial Times, in future they, and he meant European regulators, need to act like Asian bank regulators, which are unafraid to be dirigistes in limiting deposit-funded lending institutions. And I've learned quite a lot from being on MK's International Advisory Board at the CBRC, who did maintain a more diverse set of controls, even within a framework where they were moving towards a freer banking market with more competition. But nonetheless, there were tools that you could use involving reserve requirements, different loan-to-deposit ratios, etc., which had fallen out of use, frankly, in developed countries. And I think that there will be a degree of convergence between the behavior of banking regulators in the West and in Asia in the future, with both sides learning from each other. And I think that is an area where we can learn productively from each other. I think that Chairman Liu, when he initially set up his International Advisory Board, did very politely present this as an opportunity for us in the West to give advice to China. I think that the reality is that it's very much a two-way street at the moment. Fourthly and lastly, and here is an echo of what Michael Spence said yesterday about preparing for trouble and ensuring that you've got the right decision-making frameworks and that people have confidence in each other during good times in order to be able, for them to be able to act effectively in a crisis. It's very clear in the EU that the decision-making structures are not adequate to cope with a fast-moving financial crisis. I mean, that is so evident, it's painful. Interestingly, I recall a conversation I had when I was at the FSA with Jean-Claude Trichet at the Central Bank, and we talked about this. We talked about what would happen if there were a major financial crisis in Europe. At this point, I can't say we forecast the way one would turn out. This was about 2002. And Jean-Claude said to me, he said, well, I know, we all know who would need to be in the room to resolve this if it happened. And it would clearly involve the President of the ECB, it would clearly involve the Chairman of the FSA in London as the biggest financial centre in Europe, and we listed the people. And I said to him, well, that's absolutely true, but the fact is this group never meets, actually. And it did not. There was not, in fact, an effective crisis management group in operation. And indeed, I would argue there still is not although the European Systemic Risk Board, now chaired by Mario Draghi, is probably the nearest thing we get to it. And I think that to think about that in an Asian context and to say, if we did face a major market disruption again, like we had in the late 90s in Asia, what would the decision-making framework need to be? Who would need to be in that room to act decisively and quickly to deal with it? And ask, do we have that structure in place? And my hypothesis is the answer to that is currently no. And that's a gap that could usefully be filled. Teh Kok Peng, that's my 4 lessons, so I'll now hand you back to Asia after this brief, and I'm happy to seek a diversion into Europe. Thanks.
Thank you, Howard, for interesting presentation. Can I call upon Mr. Mingkang now?
Thank you. I will be very brief because everybody knows recent changes and colorful news brought by Howard to us once again highlighted that the weaknesses of the global financial system. And so we got to recheck our thoughts and to see what happened in this area and where we can improve and better our systems to guard against our future war, past the war. I think 5 points in my mind deeply I want to share with you. The first one is that Asian should work hand in hand and very hard to develop strong capital markets. And there are 3 facet stories here. Talking about the strong capital markets in Asia, if you look at including the Chinese ones and many others, we definitely will be meeting 3 stories. The first is size vis-a-vis depth. The size is very conspicuous and attracted almost all the eyes of those people from every corner of the world. But it doesn't make any sense to talk about size itself. By the end of the day, the depth of the capital market that works. So this is the first. And the second point is the relationship between the stock market and the bond market. And we have for quite a long time, Asia enjoys a comparatively good market of stocks, and we got lessons and experience both from that. But talking about the bond issuance and bond market, I don't think it's quite ripe until now. And the third one is how we can balance the performance vis-a-vis the culture. And what we need in this, to play the games, you got to know the rules and got to abide by the rules. So I think the value culture vis-a-vis the performance, sometimes you can hear a lot of ballyhoo about the performance in Asia. But then if you look at in the details carefully, then automatically it will popping up a lot of questions around value and culture and integrity as well. Second, when we talk about strong capital markets, we need strong stakeholders, such as a lot of quality intermediaries, like rating agencies, auditors, solicitors, the whole legal framework to support that. And we need a lot of quality fund managers, have a long commitment to the customers and the markets both. And they can offer the source of the economic return, value, reputation, and also, far more important, is risk management. So plus them together, and including the regulators and the supervisors and all these long-term and short-term investors, these stakeholders got to be stronger to support a stronger capital market here. And the third is that nowadays something happened in a quiet way. A lot of people didn't notice that in Asia, but actually it happened in Asia. Let me set up a Korean example. Korean, in the past 4 years, in the midst of the difficulties and challenges, the government took the lead to sign more FTAs than any other country in this region. And they set up the benchmark for themselves in housing. This is off record, and the first point is that the more the better. The second is the sooner the better. When you sign FTA with someone else, you got quickly activize that. So that's the role played by the government to make sure that the FTA will become a main driver of the regional trade and growth and investment. It brings and is bringing huge benefits to LG, Hyundai, and many others. So, in my mind, I think intra-Asia trade and investment should be maintained and protected, and they shouldn't be unfairly tarnished by external effects. So, intra-Asian FTA with new standards and the benchmark like green economic growth it got to be a main driver of regional trade and growth, and the driver of the integration of finance and the capital markets. And the good news came that China, Korea, and Japan, the 3 countries sit down together in talking about the FTA signing and arrangement on this. And good news also came from Singapore, and it's a lot of people surrounded Singapore and talking about a very excellent quality level and a platform to pay, to linking with each other to promote the trade and investment. Fourthly, I think we try our best to improve the regulatory coherence. We don't need identical treatments from country to country, because every country has its unique characteristics. But facing a lot of pending issues coming from BCBS and FSA, still today, a lot of controversies around liquidity coverage ratio, and for example, it's caused a lot of backlash. And so for such a complicated situation, I think Asian countries should hand in hand to work together and have rigorous insight into the new framework of regulation and supervision. And such a regulatory coherence in Asia will set up an example for the whole world, and to show that in the future, the toughest question, the cross-border arrangement, when we meet fading institutions in financial sector, could be concretely solved and quickly solved as well. So this is very important. Last but not least, number 5, deeply in my mind, is we do need a much stronger protection of property rights, intellectual property rights in particular. What happened in the future, or what happening now, a lot of people didn't notice that, is that we are facing the 3rd industrial revolution. It will brought huge changes, sea changes of people's mindset, the behaviors, and the way of doing the businesses. People do not need to go to office and to go to somewhere else to attend a conference like this. Yeah. It's a real story to see the 3D design, 3D printing, and the 3D delivery of persons to attend the conference for. Okay, when that happened with this appropriate cost level, that we brought this another sea changes, heavy pressures upon industrialization, urbanization, and into our daily life. Are we ready to do this? We got to